Is China's economy really collapsing, or is it a slow reset that just hurts more because it takes time? Today, I'm going to break it down in four parts: housing, debt, jobs, and demographics, and prices and exports. I'll keep it simple. No gibberish. Just what is happening, why it matters, and what to watch next. For many years, China grew fast. Entire districts rose out of farmland. Ports expanded again and again. High speed rail stitched the country together. That story is still there, but a different one is playing now, a long cool down. It's not a single crash. It's more like running with a weighted vest on. You can still move, but every step takes more effort. Let's start with housing, because housing touches everything else. For a long time, housing was the engine. Families saw apartments as savings accounts made of concrete. Local governments sold land to raise money. Builders had endless work. That loop kept spending high and jobs steady. But in the last few years, prices have slipped, sales have slowed, and new projects have been put on hold. In August this year, new home prices fell 2.5%. Out of 70 big cities, prices fell in 57 of them month to month, and in 65 of them year to year. Property investment in the first 8 months of 2025 was down 12.9% from a year earlier. When people see the value of their biggest asset fall, they spend less. They cancel a home upgrade, they hold off on a car, they skip a vacation. Confidence fades. Think about a typical family. Mom and dad both work. They saved for years to buy a small apartment in a new district. At first, prices looked strong, so they felt secure. But then their building took longer to finish. A friend's project across town stopped halfway. The local sales office is quiet now. When they look at the market, they don't see quick gains anymore, so they cut back. They wait. Millions of small choices like this become a big force in the data. Developers are still cleaning up past debts. During the boom, some firms borrowed heavily to buy land and build fast. When sales slowed, cash dried up. Some companies stopped paying bills. Some tried to restructure. That creates doubt for buyers, and doubt slows sales even more. It's a loop that takes time to break. Does this mean housing never recovers? Not at all. But housing turns slowly. Even with lower mortgage rates in some cities and easier purchase rules, it can take years for supply and demand to balance. That means this drag may stay with us for a while. Think of it like a slow leak in a tire. The car still moves, but the ride is rough unless you stop, patch it, and refill it carefully. While housing cools, we also have to talk about debt. During the boom, cities built roads, subways, parks, stadiums, museums. Lots of things that improve daily life. Much of this was funded with borrowing, sometimes through local financing arms that sit off the main budget. When land sales were strong, it worked. As housing weakened, the cash that once covered interest payments became less steady. So local budgets got tight, and more debt had to be rolled over or swapped for longer terms. Debt does not end growth by itself, but it changes the choices you can make. It is like a heavy backpack. You can walk, you just can't sprint far. When budgets are tight, projects get delayed. Repairs take longer. Small firms that build or maintain public works may wait for payment. Banks become more careful and screen borrowers harder. That can make it tougher for new ideas to get money. There is also developer debt. After years of fast building, some companies must sell assets, negotiate with creditors, or focus only on finishing ongoing projects. This process can protect homebuyers in the end, but while it happens, it chills new demand. People want to know, will my home be finished? Will the building have quality? Will my money be safe? Until those questions feel settled, sales don't bounce back fast. Now let's talk about people, jobs, and demographics. Jobs for young people are still tough. The youth unemployment rate hit 18.9% in August 2025 under the new method that excludes students, up from 17.8% in July. That's the highest since the change. Many graduates want stable work in big cities, but openings haven't kept pace. Some take delivery jobs, sales gigs, or try short courses to learn new skills. This period can be rough on spending. If you're not sure about your next paycheck, you cut back on eating out, new clothes, travel, and even small treats. That hits the service sector and small shops. Demographics add another layer. China's population fell by about 1.39 million in 2024 to roughly 1.408 billion people. Births were about 9.54 million, and deaths about 10.93 million. That means fewer young workers entering the market and more retirees. An older population isn't a bad thing. It's a sign that people lived longer lives, but it does pose a math problem for growth. Fewer workers plus more seniors can mean slower overall output unless productivity jumps a lot. It also changes what people buy: more healthcare, more elder care, and different housing needs. There's demand in those areas, but building them up takes planning, training, and time. One scene that always sticks with me is the park at sunrise. You see older folks doing group dances, stretching, chatting. It's peaceful and good for health. It also says something about the economy. This is a generation that saved hard and lived through big changes. They are careful with money. They want safety and steady income. That mood shows up in the data too. More saving, more value seeking, less impulse buying. Finally, prices and exports. Consumers' prices fell 0.4% in August from a year earlier. That is a small drop, but when prices fall, it often means demand is weak and competition is strong. Stores cut prices to draw people in. Companies trim margins to keep orders. Exports were up 4.4% in August from a year earlier, but that was the slowest growth in 6 months, down from 7.2% in July. Orders to some markets, like the United States, have been choppy. New trade rules also add friction. That doesn't stop shipments, but it does raise costs and uncertainty. There are bright spots. China still makes and ships a lot. New industries like electric vehicles, batteries, solar gear are growing. But even fast-growing new sectors need time to match the size of the old ones they are replacing. Think of it like renovating a kitchen while you still need to cook dinner. You can do it, but meals will be messy for a while. So, where does this leave us? We have four linked forces: a housing slump that cools spending, a debt overhang that limits choices, tough jobs, and an aging population that slow demand, and soft prices and exports that signal a long climb back. Put together, this looks less like a sudden crash and more like a grind. The economy moves, but every step takes effort. What could help? First, housing stability. If prices stop falling and projects deliver on time, confidence improves. Households may feel safe to spend a bit more. Second, better job growth for young people. When new graduates land good work, they start forming households, buying furniture, and planning futures. That creates demand that spreads. Third, steady prices. No one is asking for high inflation, but a firm baseline where prices aren't falling would suggest demand is healing. Fourth, exports that hold, plus new products that scale. If EVs, batteries, and advanced machinery keep gaining ground, they can cushion the old sectors as they shrink. Policy can and does help. We've seen lower mortgage rates in some places, easier home buying rules, and support for local debt. The central bank has nudged rates and liquidity. Regulators have pushed builders to focus on finishing homes. But policy has been cautious and the goals are many. Protect buyers, keep banks stable, support local budgets, and avoid sharp shocks. That means the fix will be slower, not instant. Let's pause for a moment. Picture a young couple touring a small apartment. The place is not fancy, the kitchen is narrow, the view is okay, but they imagine a crib by the window and a small desk by the couch. They ask the agent if the builder is reliable, they check delivery dates twice, they walk through the hall and whisper about money. This is not a chart, but it is the economy. Multiply it by millions, and you see why housing matters so much. Now picture a recent graduate up on a scooter moving across town for the second interview of the week. It's hot, the traffic is heavy. She rehearses answers at stoplights. She hopes this is the one. If she gets the job, she'll move out with a friend, buy a used couch, and start a little life. If not, she'll keep delivering food and studying at night. Again, not a chart, but it's the economy we feel day to day. You may want to ask, if China's growth is so weak, why isn't there a big crash? Because much of China's system runs through state banks and policy channels. When stress builds, the system can slow the pace, stretch payments, and keep things moving. That reduces the risk of a sudden break, but it also means problems can linger. It's like putting the economy on a gentle treadmill. You don't fall down, but you're also not going fast. Another question to ask: does this slowdown only hurt China? Slower growth in the world's second largest economy affects everyone. Commodity exporters feel it, luxury brands feel it, shipping lanes feel it. But there are offsets too. If some Chinese goods are cheaper, foreign buyers may benefit for a while. If supply chains spread out, neighbors in Asia can pick up new business. The global picture is mixed. Let's talk about the numbers we'll watch next. In housing, month-to-month price changes, sales volumes, and the share of projects delivering on time. In debt, how local refinancing programs progress and whether banks keep credit flowing to finish homes. In jobs, youth employment, and wage growth in services. In demographics, births, migration from smaller cities to larger ones, and the pace of elder care build-out. In prices, food and services, which show how households feel. In exports, orders for new products like EVs, batteries, power gear, and high-end tools. You may ask, how long can this last? The honest answer is that slow patches can last years. Japan had a long, slow period after a big asset boom. China's story is different, but the pattern of a grinding adjustment is similar. The key is not to chase quick fixes that create new problems. It's to rebuild trust, finish homes, clean up debt, and let new industries grow without pushing them into bubbles. What about opportunities? Even in slow times, there are many. Service businesses that help families save time, healthcare and elder care, upgrades that cut energy costs, training that moves workers into better jobs. Small, steady wins add up. They won't grab headlines, but they change lives. Before we close, I want to recap the 4 points in one breath. Housing is the heart of the slowdown. Debt is the weight that limits choices. Jobs and demographics shape demand. Prices and exports tell us how healing is going. If housing steadies, if jobs improve, if prices firm, and if exports hold with new products rising, the story can turn. Not overnight, but step by step. So, is China's economy collapsing? Today, I'd call it a slow reset with real pain points and a long, narrow path out. The direction from here depends on confidence, delivery of homes, steady jobs, and careful policy. If you follow this story, tell me the one number you watch the most: prices, jobs, home sales, or exports. I'll pin the best take. Thanks for listening.